This week on Entrepreneurs, it's the second of our three-part series looking at how to start and grow a business. Tonight we focus on the financial fundamentals of cash flow and revenue. I'm Jack Delosa and Entrepreneurs starts now.
This is Entrepreneurs.
Welcome to Entrepreneurs. Tonight we are taking a closer look at the numbers side of business, P&Ls and balance sheets, and how to tell the difference between vanity metrics and the numbers that actually mean something. An incredibly important subject for many business owners. Joining us is Chartered Accountant Jason Andrew, co-founder of SBO Financial and the author of a new fantastic book called Stark Naked Numbers. Later we'll be hearing from serial entrepreneur and startup advisor Kate Kendall. And also later visiting us will be entrepreneur and banking expert Shruti Shah of Silicon Valley Bank. Let's start with Jason here in the studio. Jason, thanks for joining us on Entrepreneurs.
Thank you, Jack. Pleasure to be here.
I like the book.
Thank you.
It needed to be written.
Yes.
What motivated you to write it?
Well, go to your local bookstore and you'll see everything you want to learn about business, right? So you want to learn about leadership and culture, there's Jim Collins. If you want to learn about marketing, there's Seth Godin. If you want to learn about how to disrupt the education industry, of course, there's this guy here. But if you want to learn about practical business and accounting for finance and accounting for business owners, all I found was the antiquated university textbooks and the Four Dummies guides. And so I thought there was a gap in the market for founders to learn and really appreciate the value in their numbers. And so as a chartered accountant and founder of a business who works with high growth businesses to manage their finances, I wrote this book to help educate and improve the financial literacy of entrepreneurs.
Jason, what are the most important numbers for a high growth business to be looking at?
So entrepreneurship, in my opinion, has become a bit of a fashion accessory nowadays. So
that is so well put. I like that.
Everyone's got some sort of side hustle or some sort of startup or an app, which is great. I'm all for entrepreneurism, but I think a lot of founders get stuck in the cycle of just focusing on raising capital, right? Ignoring, at the opportunity cost of ignoring what it takes to actually grow and start a successful business, which is make sales, make a profit, and turn up profit.
Spend less money than you bring in.
Exactly. And it's all about cash, right? But, I think sometimes we focus too much on trying to raise capital instead of funding a company with customers.
100%. Most important metrics?
Most important metrics. So sales, obviously, are important. Gross profit margin. So making sure that you're accurately coding your expenses to gross profit, net profit, and free cash flow.
What are the most common mistakes you see business owners making? I would imagine you see a few.
The most common mistake I see of all founders is that they undervalue the quality bookkeeping. So bookkeeping is seen as this administrative chore that kind of gets left to the 10th hour of the night, and founders are stuck doing it themselves. And what they don't value is the importance of bookkeeping because it underpins the entire stack of your financial function. Have you heard the term garbage in, garbage out? If you're not getting your numbers right, you can't read and understand the story that they're trying to tell you.
It's interesting you mentioned bookkeeping because I think a lot of business owners think in order to do that kind of data entry level, so I need an accountant, and accountants can be slightly more expensive than a bookkeeper. Talk to us about the key people that business owners need to help them get atop of this sort of stuff at different stages of the journey.
That's a great question. So every business should have an accountant they work with. So a lot of business owners already have a tax agent, so they do their compliance and their income tax. Most have a bookkeeper as well that does kind of the number crunching. But what I find is there's this space in the middle which doesn't get looked at or is addressed. So looking at monthly management reporting, looking at their data analytics, looking at their cash flow forecasting. And so that's a part of the job that we do at SBO. And a lot of founders ask us at what point does it make sense to engage someone like us? And what we say is usually when you get past $1 million of revenue, that's when you really need to sharpen up as a business and get these financial procedures in place.
Couldn't agree more. Now, sustaining a business from a cash flow financial perspective can be challenging and in my view requires constant attention. In the previous show on Taking Stock we were talking about Napoleon, which is a well-known beauty brand, has just gone out of business. Zumbo, who's a well-known cake and confectionery business, recently went out of business. What are your strategies for business owners, both, because you can be a great brand and still go out of business. How do business owners best manage cash flow?
It's funny because I think media has a bit to play here. So if you look in follow TechCrunch or any of the big media publications, you look at the metrics that the founder or CEO is boasting about.
Yeah.
Right? Usually it's how much they've raised,
Yeah.
employees, headcount, and revenue growth as a percentage, right? All of these are vanity metrics in my view, right? Just because you raised a buckload of money does not mean you have a great business.
Yes.
Right?
Yes.
Okay, so let's put that to bed.
Head count is expenses.
Yes,
Yeah.
and people are hard to deal with, right? Less people, the better, man. Yeah. And third, revenue growth as a percentage. Listen, 1,000% of $1 is only $1,000, okay? So all these vanity metrics, what actually matters is, again, fundamentals of your business model. Are you making a profit? Are you turning that profit into cash?
When it comes to investing back into the business for growth, what do you think in order of priority business owners should be investing into?
So my view is that everyone is great at something and most people suck at everything else, right? So entrepreneurs are typically sales and marketing and visionaries, and they should be spending all their time in that function.
Yeah.
Anything they suck at, hire people and build your teams around you to complement your weaknesses. So when it comes to hiring, my preference is to hire slow. Find the right person and take your time to do it, because I've made the same mistake of just hiring people because I felt I had to. The result is we have too many staff with no idea what they're doing, and we have to sack them because we couldn't make payroll. So,
what are the daily disciplines that you encourage business owners to embed into the company?
So a lot of mistakes I see with founders is, the first one is your bank account is not a slush fund. Okay, so I've seen business owners pay their personal mortgages, maybe their holiday, maybe their Range Rover that's on lease out of their company accounts, right? You have to remember that your business is a separate legal entity to yourself, right? Your personal finances. So respect that there's a quarantined and a segue there. The second issue is that a lot of founders I find focus on sales, but they don't focus on collecting those sales or converting those sales to cash. So working capital management, if you're an e-commerce business, inventory days, making sure you're understanding your stock cycle turns, that's really important. And the third one is actually look at your numbers. So a lot of founders they rely on their accountants every year to give them their financial statements, and they're like, oh great, I made a profit. Yeah. But what they should be doing is looking at their accounts monthly, at least, right? Be on top of the numbers, understand the KPIs relevant to your business, and so you can then make decisions and tweak your performance and your activities as you progress throughout the year.
That is exactly what happens. They leave it to their account. Their accountant might send them a P&L once a month. They kind of look over, I don't really know what I should be looking for, so they go to the number on the bottom line and did I make money or did I lose money, and then they put it aside and carry on. For those who are in that basket, who don't have, the level of financial sort of understanding that they would like just yet, what's your advice to them to finish on in order to get up to speed capability-wise?
Excellent. So there's three things in my view. So the first one is engage with your accountant. So there are a lot of accountants who might just do your tax returns and they need a bit of a kick up the bum in terms of leveling up. But there are also a great pool of accountants that actually want to help you grow your business. And typically those ones do not charge you by the hour. They won't charge you for the phone call. Pick up the phone, engage with them, and they can help to take on a self-education of journey. The second is look after your own personal finances. So a lot of founders bring their terrible personal financial situation to their business. So focus on consolidating your super and prioritising savings, save money for a rainy day. And the third, and so I recommend Scott Pape's Barefoot Investor for that. And if you want to learn about improving your financial literacy of your business, obviously check out my book. Shameless plug.
That is good advice, Jason. Thank you so much for coming to Entrepreneurs. We appreciate it.
Thank you.
We're going to take a break. Stick around.
You're watching Entrepreneurs. Welcome back to Entrepreneurs.
Welcome back to Entrepreneurs. We are joined in our Melbourne studio by Kate Kendall, who has recently returned to Australia after many years running startups in Silicon Valley and New York. Kate, thank you so much for joining us. Here we go. Kate, can you hear me?
It's all great, thanks.
Good, good, good. Now, Kate, tell us about your path to becoming an entrepreneur and how that has led to what you're currently focusing on.
Yeah, sure. So I never really sought out to be an entrepreneur. It's not like, I read Richard Branson's books, all of them, and said, I really want to be an entrepreneur. It kind of started out of a desire to find freedom in my life. So I was working a lot in magazine publishing and, finding I was going to the office and people were making toast for hours and things like that. And I just thought, I think I can be a lot more productive and to kind of escape the 9 to 5. So that's really what happened. And from there, I founded my first company, The Fetch, in 2011, and then took that to New York, and then went on to found a second company called Cloud Peeps in 2014. So, and that's really led me to come back to Australia and see how much the local market's grown as well. So it's been kind of fantastic to see Australia booming as well.
And Kate, across that career, you've obviously worked in Australia, the UK, the US. What are some of the key differences you see as to how entrepreneurs might look at the size or scale of market opportunities in the three different markets?
Yeah, definitely. So I think I've kind of changed my mind a little bit on this, because when I first went to the US, it was for a drive of a bigger market. And, you know, I thought that you had to kind of go be based there if you want to build, you know, a billion-dollar company and everything like that. But what's really happened in the last few years, especially, is with the rise of remote work and global markets, I believe that you can really be anywhere to tap into that global market. And you have to obviously localize in whatever region you're going to, but you can now run a global company from wherever you are in the world. So I think it depends on your perspective as well.
And Kate, what are the actual strengths of running a business from Australia?
Yeah, so I think after spending some time in Silicon Valley, I really saw how a lot was changing in the city. It was becoming very unaffordable to be based there. It was really hard to attract talent when you're competing with the likes of Facebook, when they're, you know, paying $1 million for engineering talent. So I think Australia has a really good market because it is relatively untapped by global tech players at this stage, but also because it has, you know, the quintessential lifestyle and family-friendly aspects. I think there's many cities that you can be based in Australia. It's not just Melbourne or Sydney that offer a really great place to build a tech company.
That's a great message to hear. Kate, in this episode this evening, we've been talking a lot about vanity metrics. In your view, what are the key vanity metrics or pursuits that can hijack an entrepreneur's focus, and what should we be focused on?
Well, I think it is kind of touched on that conversation about raising money as well, because I've kind of come out of that Silicon Valley growth at all costs model and being out the other side and raise the money and everything like that. And part of that are the vanity metrics. You know, people do look at press mentions and how many users you have. But what I've, you know, slowly started to kind of champion is really what makes a massive difference to your bottom line. What is the metric that is going to drive engagement within your product or service day to day? What converts customers. So I think that we need to focus a lot more on the day-to-day tangible business metrics that make a difference, rather than, you know, some of the glamorized metrics that you see people use often in press articles.
Let's dive into that a little bit, Kate, because your background is one of raising capital, as you say, but you are a huge advocate for bootstrapping, looking at the fundamentals. Can you expand a little bit on why you think that's so important?
Yeah, so as I started out with my entrepreneurship journey, I think there was that message which, you know, you're not taken seriously unless you have raised money, and so much of kind of the focus of your journey is focused on how much money that you raise. And I went through that and raised, you know, $1 million seed round and was kind of on that journey. And it was through being in that process that I realized, wow, this is, you know, only one way to build a company. You can build companies in multiple different ways. And I think there's this kind of dirty word in tech startups where people call things lifestyle businesses, which it doesn't have to be, you know, all or nothing. And that's why I tend to now use the word indie companies, where people are raising smart amount of capital and they're not diluting their cap tables too much. You know, I see that a lot. If you even go to get an IPO, often they've diluted, the founder has, their cap table so much that they're getting very little financial return personally. So I think it's all about looking at why you're building a company, what kind of pathway and exit that you're looking for, and sometimes it's not all about raising as much money as possible.
It's a very refreshing message to hear spoken about, Kate. Now, you're currently working with female founders in your new venture, Addo Accelerator. Why is it so important to you to support women in such a focused way?
Yeah, so I noticed that a lot of women, unless they knew how to code, they were kind of always looking for that technical co-founder, or going to agencies and paying, you know, $50,000 for an MVP, and just kind of not really knowing how to make that first step. And through what's happened with the explosion of software services, and it's a lot cheaper now to start a company, you can use a lot of services and tools online to bootstrap something together yourself, get some revenue, and then grow smartly from there. So part of Atto is kind of championing that indie way and teaching founders how to build a company in a sustainable and scalable and independent driven way. So a lot of kind of online, it's all online as well, which is a big thing, I think, as well. But yeah, definitely more about learning how to do it yourself. And I think female founders could use that education. And then also part of the program is it's free and it doesn't take equity. So if a founder did go on to, not raise money, or they do want to raise money, they have that freedom there to kind of keep their cap table without any equity on it.
Kate Kendall from Atto Accelerator, thank you so much for joining us on Entrepreneurs with a very refreshing message.
Thanks so much.
We're going to take a break, and when we return, we're going to speak to Silicon Valley Bank's entrepreneur in residence who's currently down under. Stick around.
You're watching Entrepreneurs. Welcome back to Entrepreneurs.
Welcome back to Entrepreneurs. We are joined in this final segment by Shruti Shah, who is visiting Australia and has a fascinating background, firstly as an entrepreneur and more recently in guiding entrepreneurs in the role with Silicon Valley Bank. Now, Shruti co-founded Move Loot, an online marketplace for second-hand furniture in 2013 that rose to success very quickly, raising more than $20 million in US funding, expanding into 8 American markets. This business then closed in 2016. We're joined by Shruti to discuss his entrepreneurial and executive journey thus far. Shruti, thank you so much for joining us.
For having me.
Shruti, tell us about that entrepreneurial journey and what you learnt not only from your success, but ultimately the failure of the business as well.
Yeah, so as you mentioned, I had a pretty incredible startup journey. And, I learned a lot while we were building our company. We, as you mentioned, raised a substantial amount of outside capital. So you learn a lot about fundraising, about growing a team, managing a large team. But I think for me, the biggest lesson I learned was one in finding your voice and knowing when to speak up, especially when you have a lot of cooks in the kitchen. We had a lot of investors and board members who were kind of influential in decision-making around the strategy of the business. And I think in retrospect, wish that we had spoken up a little bit more about where we wanted the business to go.
Shruti, that's a really interesting point. One of the things I often think is when you get a committee dynamic, particularly at a board level or at a management level, it can dilute the integrity of some of the idea or the strength of the ideas that are being tabled. Can you talk to us a little bit more how that dynamic affected decision making?
Yeah. So as you mentioned, it definitely does affect decision making. I think in Silicon Valley, there's a mentality around growth at all costs. And when you raise a lot of outside capital, your investors are looking to get a return in a certain period of time that is, an outsized return. And so as a business, your interests as the entrepreneur in building a sustainable company may not always be aligned with the interest of your investors, because your investors are, looking to get that return pretty quickly, and they're giving the same advice to every company, as tailored as it may seem to you at the time. And it's just really important, I think, to go back to what you know about your business and the fundamentals of your business, and make sure that you're able to separate some of the noise that I think often goes on in those conversations.
Shruti, I must say I admire the courage that you're demonstrating in talking so openly about this. It is really good to see. Let's talk about your current role with Silicon Valley Bank. What is the focus of your work there?
Yeah, so I have been in this role for about 2 years. I got very lucky as I was shutting down my company Claire Lee, who's the head of the early stage banking practice, just said, why don't you come hang out at the bank while you figure out what you want to do next and help some of our entrepreneurs. So in this role, I get to spend a lot of time doing things like this, where I get to come to Australia and meet with amazing entrepreneurs here. But I work with a lot of entrepreneurs in Silicon Valley and help them with strategy or growth or working through challenges that they might have. And I also have the time to start thinking about what's my next idea.
I've got a bit of a double-sided question. Having been in a startup environment, raised the money, and now in a large corporate environment, what are some of the things you think that corporates can learn from early-stage ventures and some of the things you think that startup businesses can learn from larger businesses?
Yeah, I think that's a really great question. I think one thing that startups can really learn from corporate businesses, I think, is the focus on cash flow and profitability. I think a lot of startups are pushed to grow, perhaps before they're ready to grow, and in return, aren't able to necessarily hit the growth targets that are put upon them. And then I think conversely, corporates have a lot to learn from startups about how to be nimble and adaptable. There's somebody on our team that's written some great articles on something called the adaptability quotient, which I think is a really great message. A lot of people that work at startups have to learn how to be adaptable because the situation is always changing, and I think that's not something you always see in a corporate environment.
Shruti, how do you counsel people on financial goal setting? Striking the balance between that tension of thinking big and being realistic and managing present day.
Yeah, from my perspective, and obviously I had a more extreme experience, but I just believe that founders should have as much control as possible. And by control, I mean they should be focused on profitability so that if and when they decide they want to raise outside capital, that those conversations kind of come from a more level playing field than a power dynamic where they're reliant on the outside capital. Because they aren't profitable. And so one of the things I spent a lot of time talking to founders about is, trying to find product market fit as quickly as possible and getting the company to profitability as quickly as possible, which may be counter to a lot of the advice that VCs give out. But I just think it's extremely important given that, if you want to be able to run your business for a long time and you want to be able to kind of control more of the company, I think it's important that founders have that kind of ownership over the company.
Shruti, as you probably know, there's a lot of Australian entrepreneurs looking to the US market as somewhere to go to tap into a larger market. What advice would you have for entrepreneurs about heading into the US?
Yeah, well, in the US, there's also a lot of startup activity, and I think one of the things that's most important for entrepreneurs, I think, everywhere is to really, really know your customer. I talk to entrepreneurs all the time who feels like they're guessing about what the product can do. And at the end of the day, if you really want to build a big business and a scalable business, you have to talk to your customers early on and make sure that you're really able to find product market fit pretty quickly. Because if there's no market for your product, scaling it is going to be very challenging.
Amen. Shruti Shah, thank you so much for coming on Entrepreneurs. It's been great to talk to you.
Thank you so much for having me.
Thank you. That's all we have time for tonight. Tune in next week for part 3 of our business special. We'll give you a detailed guide on how you can scale your business to 8 figures and more. If you want more Entrepreneurs, you can watch us anytime on Foxtel Go and up on the catch-up section of yourmoney.com.au. I'm Jack Delosa. Good night.